Good morning from London. I'm Anna Edwards alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. US futures point higher after a sluggish start to the year. The euro hits its weakest point against the dollar in nearly 2 years. Tesla deliveries missed the mark, with full-year vehicle sales falling for the first time in over a decade, despite a fourth-quarter sales push. Plus, South Korean investigators failed to arrest impeached President Yoon Suk-Yeol after being blocked by his supporters and security team.
Anna, let's get back to the market to talk about what is happening this Friday morning. It's a surprisingly busy morning. There's actually a fair amount going on right now. Eurostoxx futures a little negative, but not that negative. The real action is elsewhere. Euro-dollar pops a little bit, but we're trading with a 102 handle. Pay attention to that. The CSI 300, the Chinese stocks fell into the close. That's a very bad signal. You want the connection into Europe this morning? Take a look at what's happening with iron ore. Iron ore is down pretty sharply. Take a look at what's going to happen with the European miners, the London miners, as we get going with European trade in an hour's time. The countdown to the opening trade, it starts right now. Friday morning, good morning. Let's talk about what we've got on the agenda this morning, because actually, in a weird way, the week starts today. We're actually getting going today with a fair amount of news, and there's a fair amount of action around the world. I know we were joking yesterday that the kind of story didn't start for 2025 until Monday, maybe even the 20th with the inauguration of Donald Trump. But this morning, Hannah, there's a lot going on. Yeah,
when is the start of this year? At a point we're still discussing. Today is the conclusion right now. 3rd of January, then, it all kicks off. So we see, just to cast our eyes back to yesterday and the negativity we saw in US stocks yesterday, because I think that's important. The fifth session of declines is what we've seen. And actually, we've seen the longest, if we go back to 2024, the longest year-end losing streak since 1966. That's quite a niche statistic about the year-end. But because it goes back such a long way, I thought worth mentioning. And we're seeing a continuation of that now, or at least we were yesterday. Futures in the US do point a little bit higher, maybe something a little more positive around the corner. But it's interesting that one of the drivers of yesterday's weakness, there are stock specifics we'll get to, but one of them could have been the positivity in the claims data. The fact that the jobs market not falling over as quickly as some had expected. Is that going to mean we wait for the Fed cuts a little longer than we anticipated?
211 was the number. That's an 8-month low on US claims. That's a labour market that still feels fairly strong at the moment. How does that influence Fed thinking and the number of cuts that ultimately must be delivered? Some of the nowcast data was downgraded, which I also thought was quite interesting too. So there's kind of a yin and a yang on that story as well. There were some jitters, though, around the market yesterday, which I thought were interesting. So the market's clearly coming into this year aware of the fact that we're trading at elevated levels. Yeah. But the selling was reasonably broad, and it wasn't just in some of the high-tech names. Yes, Tesla and Apple came under pressure. We'll talk about those in just a moment. But the selling was actually reasonably broad. So are we learning anything in terms of market sentiment? Yeah. On that day one, that kind of initial session, is it telling us anything useful about what this year is going to look like?
Does that nervousness that we saw at the end of last year and into yesterday's session broadly around equity markets and risk assets, does that tell us something about nervousness ahead of a new presidency in the United States and all of the unpredictability that's going to bring? But on another story, we didn't turn a corner. We saw dollar strength, a continuation of dollar strength. Yeah. So for all the things that markets might be nervous about, they feel that they will add up to a stronger dollar. And that's what we saw playing out yesterday. The euro was weak and the pound was weak.
Is it a... We'll come on to the pound in just a second. Is that a signal of the market's being worried? You hide out in the dollar? Is that the first place you go? If you're worried about stuff, you buy the dollar. Is that the logical thing to do? Or is it just that the US economy just looks better than everybody else, and as a result of which it continues to suck in money? I don't know yet. Is this a US exceptionalism story, or is this just a defense story that the dollar plays very, very well?
Yeah, it seems to be possible to build a strong dollar case based on a whole host of different assumptions about 2025, and that seems to be where the market's mindset is stuck right now, and certainly the euro paying the price with those interest rate differentials expected to get deeper across the Atlantic. Shall we pivot to some of the individual stories that were in focus yesterday, because Tesla was really, really interesting.
So I got a bunch of... I've written down 5 points that kind of relate to some of these stories which are worth paying attention to. I think Apple's also worth paying attention to as well. So you get the Tesla numbers. 495 versus 512 was the assumption. This is Q4 numbers. These are deliveries. These are thousands. So 495,000 versus 512, the estimate. So that's a miss. So Tesla doesn't do well on the back of that. You then fold in, there's a whole bunch of other stories as well that kind of go around this. So you've got what China is doing on batteries, which I think is really interesting as well. So pay attention to that. It's looking maybe to control the lithium story. It's looking to control and protect its lead when it comes to the battery narrative as well. That's quite interesting as well. There's a read across into Europe off the Tesla story too, which I think is interesting. The US has come out with a new list of companies that are, or cars that are able to access the 7,500 subsidy that you get. The ID4, the Volkswagen vehicle, no longer eligible for that full 750, but all 4 Tesla vehicles are, including the Cybertruck.
Right.
So that's quite good for Tesla. Then you look at Apple as well. Apple, under pressure. Apparently there's a Reuters report suggesting it's having to subsidize phones in China, but the Chinese are looking to subsidize domestic production as well. So this narrative around kind of this fragmentation of the car industry, the smartphone, fascinating in terms of going into 2025.
Yes, and it is interesting to think about the role that Elon Musk is playing now with his ambitions much wider and, with a seat at in the White House, it would seem. And where does that leave Tesla and its ambitions? We talked a little about that yesterday, and Liam Denning out with a nice piece on the Bloomberg terminal talking about that. But I did think in the wider context, yes, Tesla was weak. Yes, Apple was weak for the reasons that you've outlined. But there were some of the Mag 7 doing okay yesterday, and as if it's not throwing out the whole AI story. It's not as if everybody's worried about AI all of a sudden.
NVIDIA actually adding quite a lot over the last few days, and there's a lot of calls out there for NVIDIA to continue to do well in 2025, and that should be one of the standout stories that we should continue to pay attention to. So we'll watch what is happening there. November, actually, it's interesting. China November smartphone shipments down 5.6% year on year. That data just hitting the screen right now. The Chinese are talking about subsidizing, giving credits to consumers to buy smartphones.
Right.
And this just goes to this idea that they can't figure out how to get the economy going. And you see that in the bond market today, and you see it in the Chinese stock market today. That's the story that is going on at the beginning of this year, big time.
Are we all
Chinese assets are under real
and are
pressure.
we all about subsidies and incentives then to buy anything, to buy cars, to buy phones? Let's move on to South Korea, Guy, because the pictures coming out are worth monitoring, certainly, because of what we've heard about the clashes taking place here. So attempts have been made to arrest former President Yoon. We know he's been impeached and a warrant was out for his arrest. The law enforcement officials tried for 5 hours to access his residency and to arrest him, but they were blocked by his own supporters and by Yoon's security team. So you've got a fascinating development here. You've got a fascinating demonstration of different parts of the security apparatus essentially standing off against each other. The law enforcement team backed off. They said it's impossible to execute this warrant. They've been urged to go and try again, but it doesn't take very much for this to get more difficult than the pictures we see in front of us right now.
So can you explain something to me? Because I'm a little curious about this. I came in this morning and I read a report saying South Korean stocks are up. South Korean stocks are up because there's stabilization in the political story that we see. Maybe that story, that sort of chaos that we've seen over the last few weeks is bottoming out. This doesn't feel like that.
Right, I know. If you think about all the things I just went through and the level of instability we're seeing, it doesn't feel like the end of a story. It feels like the story is still ongoing. But if you think this is going to be successful and then from a market's perspective, maybe you draw a line in the sand and you say, unless there's another big constitutional crisis, maybe it's time to buy South Korean assets. But we'll talk to guests about it, find out, because it seems incongruous that we have that demonstration of different parts of the security apparatus going up against each other, and at the same time, small caps in Korea up by more than 2.5%. It seems like a strange mismatch.
We'll see what happens as this story develops. If it gets worse and we see the standoff continuing and it's difficult to arrest Yoon, I think it's going to be interesting to see how tomorrow or Monday how these stocks react. We've got some great guests lined up, as Anna's been saying, to work our way through some of these really interesting stories that we're watching today. Karsten, Junius, Bank J. Safra, Sarasin, Chief Economist, going to be joining us. Oliver Jones, EY-Parthenon, Geostrategic Business Group leaders, got some really interesting insight into what we're going to be looking at this year. Bixuan Shu, Royal London Asset Management Fund Manager, joining us a little bit later on in the next hour to give us some perspective on what she's looking forward to in 2025. What else do you need to know this Friday morning? Got to get ahead of myself. The US banking system reserves have fallen below the key $3 trillion mark and are now at the lowest level since 2020. The reduction tied to year-end dynamics, quantitative tightening, loan repayments, which drained, of course, liquidity from the financial system. Now, Wall Street strategists have been paying close attention to the lowest comfortable level of reserves, which some have estimated lie between $3 and $3.25 trillion. The new number will, of course, factor into the Fed's thinking about when it will end QT, a huge kind of story for 2025. 2024 was an upbeat year for the hedge fund industry, in particular multi-strat funds of all sizes produced mostly double-digit gains. Large funds, Millennium, Citadel, DE Shaw had returns ranging from 15 to 36%. Smaller funds like Schoenfeld's also had strong returns, rebounding from weaker performances in 2023. And Bloomberg has learned that President Joe Biden has decided to block the $14 billion sale of US steel to Japan's Nippon Steel. The official announcement is planned, we understand, for later today. The Washington Post earlier reported that senior advisors raised concerns that the move may hurt relations with Japan and tried to persuade him not to take this decision. End of the Biden administration, we've known this was going to be happening. It's clearly going to have an impact on relations with Japan. Japan and the US, in theory, should be very closely tied together. I'm still scratching my head about this one.
Yeah, and let's remind us how we got here. This went to CFIUS. This shouldn't have ended up on Biden's desk necessarily for him to decide, but this went to CFIUS. CFIUS was deadlocked, which is the body that decides on foreign takeovers, of course. They were deadlocked on the decision, so that's why it ended up on President Biden's desk. He has already indicated that he would oppose this. A lot of the things he's said so far have suggested that he wasn't a big fan of this going ahead. So I don't know if that is necessarily a surprise if he is going to block it, as our reporting suggests. But this got caught up in the election campaign, didn't it? And then national security concerns are mentioned a lot, and whether you need to keep domestic ownership of these key manufacturing assets becomes a political topic. And even though we know who's going to lead America and there is no electoral campaign to fight, it seems it still is steeped in politics. And maybe this is the new geostrategic world we live in.
You break apart any device in America, break apart your Apple iPhone, break apart any piece of technology, there will be huge amounts of Japanese kit in there. Japan and the United States are incredibly closely tied together in terms of their industrial base and the interoperability of the kit and all kinds of different things, really important. So why is steel, and ownership of steel, so important?
Is it a history thing, a legacy thing, the influence that that particular union has? You know, they had a very vocal voice during the election campaign.
Boeing airplanes, Apple iPhones, everything. Lots of Japanese kit.
Yeah, it's almost as if it's not about who's buying it, it's just about it not being American. So that seems to be where we are on that one. So we'll continue to monitor that for updates, of course. Coming up on the programme, we'll get the latest on the European gas story after an outage in Norway added to concerns over the end of the Russia-Ukraine transit deal. Plus, Rolex values surge as gold prices rise. We'll talk fancy timepieces a little bit later on in the show. It is Friday. Just checked. It is Friday. Up next, back to the market story as the euro stumbles and stocks get off to a shaky start in 2025. If you have questions, if you want us to put them to our guests, IB plus BBTV Go. That's the function this Friday morning here in London. This is Bloomberg.
$2025 is 3 days old, and it's already proving to be fairly bumpy. US markets have had a fairly rocky start. We've seen equities moving lower. Fifth day yesterday, a little bit of a bounce this morning. How long can we hang on to that? Let's try and find out. Valérie's here.
Guy, it was a rocky start, but also quite a volatile start in yesterday's trading session. The S&P 500 index had a near 2% intraday swing, ending the session lower. It tried to rally off the gates, but we ended the session lower and now snapped a 5-day losing streak for the broad U.S. benchmark. Is it going to be U.S. politics that points us in a direction from here? We have the 119th U.S. Congress sitting in D.C. today, or perhaps the economic data. We have U.S. ISM manufacturing data dropping at 3 p.m. London time, or could it be a surprise that we don't have on our minds yet? We also saw a bout of dollar strength in the first trading session of the year. A lot of that focused negatively on the euro. And Guy, this is interesting because this is quite a consensus position. And sometimes in January, we do see those consensus positions being squeezed. We have not seen that yet. We saw the euro slide below the 103 handle, trading now at 102.75. I also want to point out how the divergence between the U.S. economic story and the European economic story has taken steam. Now, this is a chart here. This blue line is the consensus forecast for 2025 for the Eurozone. This white line is the consensus GDP forecast for the U.S. You can see since Trump was elected back late last year, we have seen quite a divergence. We have economists penciling in only a 1% GDP gain for Europe. In the meantime, for the U.S., it's looking nearly double that at 2.1%.
Valerie, thank you very much indeed. There's a lot going on. Day three on what could be a very bumpy year, a bumpy start, as Valerie points out. Huge swing yesterday in the S&P. Let's go to Zurich. Karsten, Junius, chief economist at Bank J. Safra Sarasin, joining us from there. How bumpy do you think the year is going to be, Karsten?
Well, we should note that the expectations for the U.S. economy are extremely high, and we increasingly see this reflected in 10-year treasuries that are now seem to establish them above 450, a level that I believe will be too high in the medium term. So what I can imagine is that we have quite strong data in the U.S. For the next few months, and weak data in the euro area. But at some point, I believe that interest rates matters, that interest rates will bring down the U.S. economy to a certain extent, and that interest rate cuts in the euro area might lift sentiment over there, such that we are getting a kind of cyclical convergence of the two important economic blocks in the second half of the year. That doesn't mean that we are getting a structural convergence. So the growth story will remain much better in the US than it is in the euro area, but cyclical convergence could take place.
Karsten, why do you think that suddenly we're going to see 4.5 having an effect on the US economy? Hasn't yet. You could argue that US consumers, US businesses have locked in super cheap lending rates. They're pretty immune to what the Fed is doing right now. Why do you think finally we're going to see these higher rates having an impact?
Well, it's true. So far, they seemed to be immune, and maybe that is the whole reaction that we are seeing. So, bond market is testing out the economy. And at some point, well, we have seen a certain moderation in the labor market in the past years. We are not at vacancy levels twice of the unemployment rate anymore, and I could imagine that this moderation might continue. I'm a bit skeptic about the real estate market. At some point, I believe these high interest rates will moderate that sector, and then consumer sentiment might moderate as well. I'm also a bit skeptic that all this euphoria that we have with respect to deregulation, with respect to rate cuts, that this will be realized. So meaning some expectations might simply be too high. What President-elect Trump can deliver in the short term, like tax cuts, they are not coming overnight. And they might stimulate the economy next year, not this year. So that might be one thing. Deregulation is also something that is not really happening overnight, but it's all affected already.
OK. Karsten, you said then that in your first answer that interest rates where they are, to pick up on this conversation, interest rates where they are will bring down the US economy. I mean, or at least perhaps you mean take the edge off it. That sounds like something that's going to attract a lot of political attention in 2025. This might be out of the remit of an economist, but is that something we need to bear in mind this year?
Well, politics will shape markets. That is absolutely clear in all three major economic blocks. It's clear in the US, where we have all these positive news, positive political changes already in the market, except for the trade war that everyone is talking about, but we don't have any specifics in order to factor this into our forecast. So if a trade war would take place, well, then that would destroy sentiment. That is clear. In Europe, we need a lot of political choices, changes. So we have elections in Germany and in France, but expectations are low so far that we get real changes. And then we have China, which said that it would stimulate the economy, but so far we are really missing specifics. We are waiting that something is happening, and clear the potential for a big push. Something that is stimulating the economy is clearly there.
OK, and what do we assume the levers will be that China will pull on, Karsten? Because I'm looking at a red headline on the Bloomberg terminal today that says the onshore yuan has weakened past 7.3 to the dollar for the first time since 2023. I mean, is that something that China will want to see to stimulate the economy, or something they will use other levers to prevent developing too much?
I'm not sure that China would like to see this at the current stage. I think would be a rational development once we see tariffs from President-elect Trump. Then last time we saw a weaker one. That is true. In order to compensate for these tariffs, I believe that is rather a reflection of the weak Chinese dynamic that we have so far, which is also reflected in ever declining bond yields in China. That is something that we should actually bring together. So weak currency is a reflection of weak bond yields and ever increasing yield differences towards the US dollar.
Karsten, can I come back to the relationship between all of these various blocks that we're talking about? There is this assumption in the market that tariffs are going to come, but they probably won't come as aggressively as maybe anticipated, and certainly not reflected in the language that we're hearing from Donald Trump. But there's another tweet out overnight in which he just talks about the opportunity to make America great again via tariffs. He talks about the fact that you can lower taxes and raise tariffs, which seems like a strategy that he wants to pursue, and balance the books and make the economy great again. Are we still in financial markets underestimating his desire to deliver the tariff story and the upset that will cause to the global economy?
So if I talk to other economists, if I look at the press, we all know and we all take him seriously in a way. That is the number one risk that everyone is mentioning, this trade war. So I think we are aware that something is happening, and we are also aware that he truly believes in tariffs. We're also aware that these tariffs don't really work. And they definitely don't work in order to balance the budget deficit in the US. That's maybe why interest rates in the US are increasing so much, as well as we are kind of factoring in a higher budget deficit. But then what we still underestimate is kind of the destructive force or potential that these tariffs have. As nowhere in the world we are actually pricing them in financial at least not in equity markets, I would say. They are still far too positive. And here I believe we will see a reaction once the specifics are getting out. We simply don't know whether it's hitting Mexico and Canada first or whether it's hitting China first. So it's difficult to price these things in. Yes.
Karsten, thank you very much. Thank you for your time. Karsten, Junius, Chief Economist at Bank J, Safra Sarasin. We thank you very much for your time, taking us through your thoughts on the US, the Eurozone and into China and back to the US again. Coming up on the programme, a lot of the things we've been discussing already, do they add up to geopolitical risk? What does that look like in 2025? We'll talk about that next. This is Bloomberg. Welcome back, everybody. This is Bloomberg's opening trade. 30 minutes until we get the start of trading. Let's have a look at the futures picture for Europe. And we're seeing a bit of transatlantic divergence early in 2025. Certainly we saw that yesterday. European equity markets didn't do so badly. And then the US equity session turned into a fairly negative one. So will we see a little bit of catch up here in Europe this morning? There's a little bit of negativity on the screen. But then US futures setting the path ahead as perhaps slightly positive. So we'll see where that takes us later on during our session. In terms of bond markets, in yesterday's session, we saw those yields going higher a little here in Europe. Today, the yields coming down just a touch. 3.218 is where we yield on the French 10-year. And I flagged that one, Guy, because we are going to see a meeting of the new French cabinet today.
We look forward to that. We'll bring you some pictures maybe a little bit later on in the programme. Let's switch over to what is happening in Germany. The politics continues there. Campaigning well underway in Germany's election. Next week, the CSU will hold a caucus meeting near Munich. Plus, we're going to get a raft of key economic data out of Europe's biggest economy, including factory orders and the all-important reading on inflation. Ollie Crook joins us now from Berlin. Ollie, we're less than 2 months away from the February 23rd election. Give us a situation report. Where are we as we head towards this election? What are the polls telling us? Where are the key areas that we need to be focusing?
Yeah, guys, so this is really interesting. I mean, what we're seeing, let's just get through the scores first, right? The CDU is actually gaining a little bit of territory, up at 31%. This is really in keeping with the trend that we've seen over the last couple of weeks and months, really, with the CDU getting support. The AfD also gaining basically half a point of support here across Germany, not just from Elon Musk, who, as we know, has taken a real interest in German politics for the last month, basically endorsing the AfD, calling Olaf Scholz an incompetent fool, calling the president of Germany an anti-democratic tyrant, and, really coming out to bat for the AfD, in basically endorsing them. This has caused a lot of frustration and a lot of concern in mainstream politicians from the CDU, from the Greens, from the SPD. The SPD has other reasons to be concerned because, as you can see, they're still there kicking around in third place, under 17% for Olaf Scholz, and the Greens coming about 12% here. But, Guy, as to your other point about question talking about really where is this support concentrated for these parties within Germany, apart from the AfD support for Musk outside of Germany, when you look at the map of Germany, the gray area here is CDU. These are state election polling, so we should say that sometimes people are a little bit more adventurous when it comes to state polling because they know they won't have as much power at the federal level, but it illustrates to you kind of a broader story. One of the stories it tells you, there is very little red on this screen. Scholz is the red party here. You see he's basically lost overwhelming support across Germany. You can see a lot of that support has gone up for the CDU, but when you look at the breakdown, where the support is for the AfD, it is only basically concentrated, or mostly concentrated, in the former communist East Germany. And even in these two regions, Saxony and Lower Saxony, basically the CDU is holding on by 1 percentage point. So there is really a very clear geographic story that we're talking about here in Germany, with about 1/5 of the vote concentrated in the East that is going for the alternative for Deutschland.
Yeah, the economic and cultural story behind that, really fascinating to unpack, Ollie. The economy is dominating the agenda. It's certainly something that's getting a lot of mentions. Put this period then of economic malaise into some context for us.
Yeah, well, listen, Anna, let's do both. Let's talk about the East as well as talking about the broader picture here for the German growth story. And we took out German growth here because we've been talking about it for the last 2 years and how difficult it's been. I thought it'd be important to put it in the context of the last 75 years of German growth. So this is basically each decade's growth, each decade since starting from 1950. So in the post-war period, you had very strong 8% growth across Germany. And then in the 1960s, about 4.5%. That moderates down to about 3% in the 70s. In the 80s, still about 3%. Then you have that key moment when the Berlin Wall fell in 1989. And after that, you see that growth has sort of tapered off at about 2% in the 90s. And in the 21st century, really stuck around 1%. What is interesting is when you break this down from individual years, there have only really been about 8 years of contraction since 1950 when we look at this. And to put it into context, 2 of those will be the last 2 years. But there's another story, Anna, and you were alluding to this, and it is the sort of geographic economic story here in Germany, because this wealth creation across Germany has not been universal. This is a chart of GDP per capita across Germany. When you look at this map, you see something very, very clear. When you look at the former East Germany, the entire section here, GDP per capita, is under 40,000 euros, right? When you see something like Hamburg, it's about 80,000. So in the poorest part, Thuringia, it is less than half of what you have in the richest part of Germany. And that is exactly at the heart of now the political story. As you say, Anna, it was a cultural and economic story, but we're seeing it really come to the fore as a sort of political story, with the AfD really gaining support in this part. When you also look at the map of where all of the companies in Germany are based, it's all around here. Very little is happening right here.
Ollie, thanks very much. Bloomberg's Oliver Crook with a deep dive there into the German economy. Now, the global election supercycle is over and newly elected governments have fresh mandates to reshape the global operating environment. That's the view of EY-Parthenon, who argue dramatic policy and regulatory changes could force executives to rethink their business models in 2025. Let's work out what all of that means. Oliver Jones joins us, Global Geostrategic Business Group Leader at EY-Parthenon. And Oliver, thank you for being with us. So let's put this into, give us your top top takeaway here. In terms of thinking about 2025, what are you looking at when it comes to geostrategic risk?
Yeah, thanks, Aaron. Thanks for having me on today. So, look, we identified three things in our recent outlook, which we put out a couple of weeks ago. The first one, as you say, is that last year with an election supercycle. So this year we have a lot of new governments, a lot of brand new governments, in fact, as well, who've kind of gone from right to left or left to right. And so the first thing we're watching is the impact of all these new governments on policy. So we've gone from elections to policy, and that policy changes. Again, we're going to see it in taxation. We're going to see it in immigration, approaches to immigration and willingness to sort of have the borders open to immigration. And we're often going to see it in climate change and energy transition policies as well. And so all three are big issues for business. But that's only one of the three trends we look at. I think the other big trend is economic competition. We are, without question, in an environment now where individual countries and certainly individual blocks are competing economically for jobs, for resources, for investment, and for kind of technological leadership as well. So that's the second big trend. And then the third big trend is, in a sense, slightly more old-fashioned, which is geopolitical rivalries. So we continue to have a number of wars, a number of conflicts, and other rivalries playing out in different places, including nowadays not just the oceans, but also space as well.
Yes, it's interesting that you separated out into those categories then, Oliver, because it seems that geopolitical risk, geostrategic risk, that the category seems to have grown so much to encompass a lot of what used to just be domestic policy making, because we seem to talk about it for anything from hot wars to domestic tax policy or domestic immigration policy can be described in sort of geopolitical terms. Is this new?
Yeah, look, I don't think it's brand new, but I think several aspects of it are new. I think the sheer speed of change on those policies poses kind of geopolitical risk. So, I mean, I started my career with the UK government negotiating WTO rounds, which used to take 5 or 6 or 7 years, and that was considered quick and progress. Nowadays, we have changes to tariffs and non-tariff barriers sort of literally overnight, and companies have to respond overnight. So I think, firstly, we're getting a sort of a huge number of speedy changes to the operating environment. I think the second point is that the scope of geographical risk has gone up. I mean, even the last sort of 5 to 10 minutes, you've talked about the new French government, the situation in Germany with new elections, the situation in the US. And we've had the news overnight from South Korea as well as sort of some of the issues going on there. And they're just a few of the issues. And so what we're seeing is geopolitical risk is coming from every source. And so that is new. The speed is new. The fact that the geographical scope is so wide is new. And then the third point is that so many sectors are captured. So geopolitical risk has always been around if you're in the oil and gas sector or the oil and gas market, and potentially in pharmaceutical regulations and those kind of issues. But nowadays, almost every sector is captured by geopolitical risk. And so those three things are very new for companies operating internationally at the moment.
Oliver, good morning. It's Guy. Let's get a little bit more specific. What are you expecting in terms of the speed from the Trump administration in which it will deliver change? How fast do you think it's going to happen? What happens on January the 21st? Are we going to see a series of tariffs? Are we underestimating the risk?
Yeah, look, I think we're going to see announcements very quickly. I think there's no question that this Trump administration is more experienced than it was previously. And so in terms of appointees, in terms of policy development, I think they're going to be ready to go very, very quickly. I think the interesting question and the uncertainty that we're all handling at the moment is how deep those tariffs are going to be, and also the timetable for implementation of the tariffs. And so we know that tariffs are used as a tool of foreign policy, a tool of geopolitics, and a tool to get sort of other policies enacted. And so we've seen the commentary over recent weeks around Canada and Mexico to try and get a change of approach from those governments. And so whilst I think we can expect announcements very quickly, it's not necessarily true that we're going to get the implementation of those tariffs very quickly as well. The implementation may be delayed in order to seek the change that the Trump administration is looking for. And that just adds to the uncertainty that businesses face, because it's hanging over them in a sense as a change, but may not be arriving immediately.
What's your current thinking on second round effects? Because this seems to be the new part of the conversation over the last couple of weeks. There's now this conversation surrounding the idea that if the US puts tariffs on Chinese goods will find their way elsewhere, for instance, into Europe, which could have deflationary impacts. Do you think we fully without understanding the sort of the primary, can we even map out the secondary effects, the unintended consequences of what these tariffs and the changes with them could lead to?
Yeah, I pick up the same concern. I've just spent a couple of weeks in Asia Pacific. Before that, it was in Europe with a lot of European companies, and they're very worried about two things. Firstly, that sort of to what degree the kind of the rerouting of goods and the rerouting of technology, which has clearly happened, and you can see it in the data over the last sort of 2 to 3 years, whether that rerouting will stop. And particularly if you're in, say, Southeast Asian manufacturers and others that have really benefited from investment and activity, is that avenue going to be closed down as the Trump administration or other actors sort of close down that route of sort of almost avoiding tariffs? And I think the other big uncertainty is, how does China respond? How does the European Union respond? How does the UK respond? How do places like Australia and New Zealand respond? Because we know that tariffs are going to be a feature of 2025, and we know that those countries and those economic blocs are not going to simply accept tariffs, but they're going to seek to negotiate in the first instance, but also probably to retaliate in some way to any new tariffs that put on their sort of goods or services.
Do you think tariffs are an end in themselves, or do you think they are a means to an end? You talk about the kind of the goals that the Trump administration is trying to achieve. There's also this conversation happening around whether or not the ultimate objective here is some sort of a Plaza Accord that leads to a weaker dollar, but a change in global flows, and the US not running this huge kind of deficit that it runs in goods with the rest of the world. Do you think that is the ultimate objective here? I'm wondering how far you think this goes, and how we should think about an endpoint or a new normal for global trade.
Yeah, look, I think the answer to that is it's a bit of both. I mean, I think in some cases we're seeing tariffs and other sort of economic measures being used as a tool of wider geopolitical competition, military sort of competition as well. But I think it's also important to remember that a lot of these tariffs are genuinely designed to bring industrial activity, industrial development, and of course jobs back onshore. I mean, we've moved from a world where people talked a lot about sort of nearshoring because of resilience, and then friendshoring because of sort of geopolitical issues, to kind of onshoring, right? It's about onshoring jobs. It's not the jobs being next door. It's being in my home country, employing my own citizens, basically. And so that's not just a US issue. There's a big issue in the EU, UK, and in places like China and other places too. And so I think it's both. I think tariffs and other economic measures are being used as part of sort of a bigger geopolitical game, but also in the very sort of short and medium term, very much so for sort of domestic, more short-term sort of economic and employment ambitions and goals.
Oliver, I wonder if you can comment on something we're watching, seeing develop over recent weeks and days. We've seen President Trump and Elon Musk, of course, President-elect Trump and Elon Musk, of course, very happy to get involved in foreign politics. So we've seen Musk, in fact, both commenting on, in particular, Musk commenting on German politics, on British politics. Now we're watching pictures of what's developing, playing out in Seoul in South Korea. Lots of US flags being waved along with South Korean flags, as if there's some sort of a appeal for US support here. I wonder how we prepare ourselves for a world where the US president is just much more willing, and his team, much more willing to get involved in foreign politics. This must be something that CEOs are having to think about.
Yes, I think it is. And I think the openness and the involvement of certain countries in sort of different countries' politics is a new phenomenon. We haven't particularly seen that before. The involvement has tended to be more behind the scenes in more traditional ways. And so I think, it's one more sort of burden that CEOs faced with such a wide range of uncertainties, a wide range of geopolitical risks across so many countries, as I've been mentioning. And the fact that sort of individual actors are talking so much in this space just adds to that extra layer of uncertainty, because because it's no longer the kind of traditional formats in which geopolitics or even economic diplomacy is being carried out. It's very different formats, and I think it's one more thing for the CEO and the boards to be kind of getting their heads around, which is why 2025 continues to be such a difficult year for CEOs and those around them.
Oliver, great stuff. Thank you very much indeed for setting us up. Oliver Jones, Global Geostrategic Business Group Leader at EY-Parthenon. Thank you very much. Coming up, we're going to talk about Airbus falling just short of its annual delivery target for 2024. We're going to talk about other stocks as well. Take a look at what's happening with the mining stocks this morning. We'll keep an eye on them. Plenty still coming. The opening bell is 14 minutes away here. You don't really have a bell, but the opening trade is in 14 minutes' time. This is Bloomberg.
Welcome back to the opening trade, Friday morning, 3rd of January. The futures picture looks a little weaker for Europe. We look as if we might be catching up with the session over in the States of yesterday, which was featured some pretty broad-based weakness. Tesla and Apple amongst the big names in retreat, of course. US futures, though, do point higher, and I mentioned that as we look ahead to the rest of the session. Let's talk about where we are on global markets right now, with a particular focus this morning on Asia. Paul Dobson, Executive Editor for Asia Markets, joins us now. Now, tell us what is going on in the bond markets in China and FX markets then, Paul, because bond yields sank to another record today. And we see in terms of the currency, China letting the yuan weaken after defending it at 7.3 to the dollar for weeks. What's the message we're getting here?
Yeah, hi, good morning, Anna. So the message that we're getting is that, the economic outlook is still pretty gloomy for China. The expectations are for more monetary easing, for lower inflation. You see that in the bond yields where we've been pushing ever lower on the 10-year. We went to the 1.6% level today. We have forecasters talking about 1% possible. We had Ed Yardeni on television today talking about getting closer to 0% yield for Chinese government bonds over time. And the view is basically, the economy is still in a funk. It's going to take more policy easing from the central bank in order to help get it out of that mire. In the meantime, there's also subdued inflation that they're going to have to deal with. And so people are continuing to hunker down in government bonds for the meantime, staying away from the equities market. That, of course, has a drag on the currency market as well. We had seen the Chinese authorities trying to prevent the yuan from weakening too far. It had drawn this level at about 7.2 against the dollar. But, of course, all the time the dollar has been appreciating. And we saw particularly big news yesterday afternoon, your time, against the euro and the pound. That puts extra pressure on the yuan as well because it's getting stronger as long as it stays with the dollar against the rest of the currency world. So pressure became so intense that it has to let it go. Only steadily, probably likely to see a gradual depreciation, not a huge sharp move or anything like that. But it's a sign that more weakness may be coming through, particularly as we still have whatever the Trump tariff look like to anticipate later this month.
Paul, why were South Korean equities higher today when we still have significant amounts of political instability? Can you draw a line between the two? Is there a line that I should draw between the two?
I would be, a bit reluctant to go too hard on the idea that it's to do with the politics. What I do think you could say about South Korea's markets is while we've had all of this political turmoil, actually what's been going on in the background with the central bank, the regulators, all those other sort of administrative bodies has been giving the market confidence, has been, putting in liquidity where it's been required. It's been much more like a developed market response than an emerging market response. And that's been pretty reassuring for global investors. Now you have some cheapness going on in the equities market that is looking a little bit more attractive. Yes, we know that Junius is on his way out and is being replaced by a different administration, but people are looking at parts of that market that are appealing. We're looking at electric vehicles that may get waivers from US taxes. We're looking as well at the EV battery space and also the tech space, which is getting a lift. And those are all helping to support the equity market today.
Great stuff, Paul. Thank you very much indeed. We'll continue to monitor the pictures coming out of Seoul. Paul Dobson, Executive Editor for Asia Markets. Let's turn to European stocks now. Miners are going to be a story, but let's start with a little Airbus action. Joe Easton, over to you.
Morning, guys. We are starting with Airbus, and the Bloomberg Aerospace team are reporting that the company is set to fall very slightly short of its delivery targets for the full year after a little bit of a weaker than expected December. Now, this stock was trading at a record high last year, has come down a little bit, but our team there reporting that the company is set to deliver close to 120 aircraft for the month, and that would be just shy of the 760 annual target. We will get the final numbers on those deliveries next week, so that'll be key for that stock. Then the miners, as you mentioned, in focus once again. This is as iron ore declines around 2.5% at the low overnight. That was on track for the biggest decline since mid-November. Has come up a little bit, as we can see, down around 1.6%. There was a lot of underperformance in these stocks, of course, last year. So we'll be watching the London-listed companies once again, particularly Glencore and Rio. There we can see the underperformance in the broader market on a longer-term basis in terms of against the SXXP. The other sector to watch is shipping. This is as Shanghai futures on freight contracts do actually decline pretty heavily overnight, down 9% at the low. I've come up a little bit since then. We're down around 5%. Going into the final moments of trading on that one. So we're going to be keeping an eye on the likes of Maersk, Hapag-Lloyd, Canaan and Frontline. Of course, those futures have been weighed on by the concerns around strikes in the US, and it does look like talks are going to continue, so that could be positive. Finally, UBS, a big upgrade today over at Exane at BNP Paribas, which reckons the bank over in Switzerland is going to be returning more cash than expected in buybacks. Keep an eye on that one in Swiss trading later today.
Joe, thank you. Our equities reporter, Joe Easton. We have then a few stocks and sectors to focus on. The auto sector you flagged earlier on as well, Guy, as a result of some changing benefits in the United States. So we'll certainly watch that. But it is still early in January. But yeah, the mine is interesting.
Mine is going to be interesting. Iron ore down quite sharply, so we'll keep an eye on what happens there. The opening trade is coming up. We're 5 minutes away. We'll count you down to the open this Friday morning. That's next. This is Bloomberg. Friday morning, good morning. Let's talk about the setup out of Thursday into Friday and what we're going to see in today's session. Couple of decent reversals yesterday. Let's talk about the European one first. Move lower and then a move into the close on the upside. But then actually the real story starts to develop. Big reversal for the US. Big reversal, big intraday swing yesterday, which is quite significant. You don't often see moves of this kind of magnitude on an intraday basis. So this big drop after the US Open. We're trying to claw back some of that, but nevertheless, some key stocks in focus yesterday. Names like Tesla, names like Apple, certainly in focus yesterday. And that reversal is worth paying attention to. Does it signal something about the fragility, the mindset of the market going into 2025? European futures absolutely unchanged at the moment on the Euro Stoxx 50. Futures on the FTSE 100 a little lower. Keep an eye on what is happening with the mining names. Anna will talk about those in just a moment. They could be significant. CAC futures, we've got the cabinet meeting this morning. Is there a relationship between the two? I'm not sure. CAC futures down by 0.1%, Anna. But it's that reversal yesterday in the United States that we've got to pay attention to this morning. But actually, I think this Friday, some single stock stories that are worth paying attention to as well.
Yeah, absolutely, and some sector stories. Let's start with the mining sector. That could be an area of weakness because we've seen such weakness coming through in the Asia session in some of the basic resources themselves. So the likes of iron ore down by more than 2% at one stage of the session. So that could weigh on some of those mining names. Airbus in focus, as we were hearing from Joe Easton. Deliveries for December, that particular month, look as if they were a little lighter than estimated. We won't get the final details until next week, but we'll watch for any response there in the share price. We're also keeping an eye on the shipping names. Freight rates in focus in 2025. We are also thinking about the restart of strike talks over in the US, Guy.
Let's talk about this market open, this Friday market open. Here we go. It is time for the opening trade. Let's see some numbers. Let's see what kind of action we get out of Europe. I'm not sure the real action is going to be at the index level. Actually, I think today might be about single stocks and sectors, as Anna talks about. The FTSE 100, as anticipated, down 0.1%. Nothing really to write home about. You've also got to factor in the move we saw yesterday with the pound, which weakened significantly against the US dollar. That affects the FTSE. The Stoxx 600 is absolutely flat as a pancake right now. It is up by less than 0.1%. The IBEX is up by 0.1%. The DAX is absolutely flat. The CAC is absolutely flat. So below the surface, things are happening. We are actually seeing some interesting moves. Keep an eye on the miners, as Anna said. Keep an eye on Airbus. Keep an eye on the shipping stocks. Let's talk about the sector story, Anna.
Yeah, absolutely. So we're kind of undecided, really, about where the sector story is going. We're almost evenly divided between sectors going higher and lower. To the upside, we have some rate-sensitive sectors, so telecom, real estate. Those are where we're seeing the best gains, but they're only 0.3%, so nothing sort of stunning. In terms of that basic resource response, taking a little time to come through, but we do now see some weakness in that sector, down by 0.2%. But actually, retail is performing a little worse. In terms of the mining names, we have the likes of ArcelorMittal, Voestalpine, Anglo-American, Rio Tinto, Glencore, all moving a little bit lower. And retailers, in terms of that sector, we've got Next, Kingfisher. So there's a little bit of negativity coming through on the retail space, but not a huge amount. We sort of evenly split higher and lower in terms of the sectors, as I mentioned, and the Stock 600 caught then in between those two dynamics, almost entirely flat. At the index level then, Guy, as you were pointing out, we do have a focus on France today with that cabinet meeting. We're down 0.2% in France, but nothing much more happening.
In terms of the point story for France, LVMH is a little bit softer this morning. It's down by around 0.6%. It's third biggest points drop on the Stock 600. Novo and HSBC ahead of it.
China currency weakness story.
You've got luxury down pretty much across the board. Hermes is also softer this morning. But you've also got Schneider down today. You've got Airbus down today. So some of the defence names are also a little softer. BAE Systems in the UK is also weakening up. But the miners are down too. Rio's soft this morning. That's interesting in the light of what we've seen out of China. But on the upside, maybe money rotating. So you've got Novo down, but Roche up. Astra up as well. Shell looks like it's gaining a little bit as well. BP on the upside too. It's hard to kind of discern a clear trend. The percentage change on the Stock 600 is 0.01% at the moment. You've got 296 up, 275 down.
Yes, but don't be deceived. There are things happening beneath the hood. If you heard that and were tempted to get back into bed on Friday the 3rd of January.
Put your slippers on.
Yeah, I mean, put your slippers on, but maybe stay at your desk. We do have that negativity in those luxury names then. That does seem to be gathering a bit of momentum. Kering, LVMH, both of those, Hermes, all down this morning. Not by more than 1%, or not by 1%, but still we see a little bit of weakness in that luxury sector.
Yeah. How is the Chinese story, I think, on the consumer is going to be really interesting. There's a story around this morning talking about the fact that the Chinese are looking maybe to boost their domestic smartphone industry by providing effectively stimulus for the consumer to buy smartphones. They're talking about washing machines. They're talking about all of the kind of kit that people buy and trying to get that consumer flywheel spinning again. OK, and we talked about the top of the programme about whether,
this year is going to be all about incentives and subsidies. Let's get into a conversation about all of this. We're joined now by Bixuan, who's a global equity fund manager at Royal London Asset Management. See if Bixuan, you can bring some clarity to 2025 and what we're expecting. When we talk to guests, a lot of people say, well, look, we know the broad strokes of Trump policy. That's the big unknown hanging over markets. But we've got a sense of where the broad strokes go. But beneath that, there is quite a lot of uncertainty and the potential for policy to diverge quite a lot from expectations. So how are you approaching 2025?
So we think that there are a huge macro whirlwind, as you mentioned, that driving global equities in 2025, and that's going to drive a wider range of outcome for performance. Like you said, so there are certain uncertainties. We know what those forces are, but we don't know exactly what the outcomes are. So I think the most important one is still the Fed rate. That's going to drive the performance and the rotation, not only in the US, but also global market. And the other forces are the Trump presidency. That also means wider range of outcome. It's not much is priced in for tariff in the US and other regions. And what does it mean for the Treasury, US Treasury?
We had a really interesting conversation about geopolitics earlier on, and Guy put this question to our guest about tariffs and about how they'll be implemented. And he reminded us of the purpose of tariffs in Trump's view, which is to try and get other participants to change course and to do things that he wants them to do, which means that the threat of tariff might come pretty soon. But actually, the actioning of a tariff might take quite a long time. I mean, is that something that the market is thinking about? Is that why we don't see more pricing in of that tariff threat?
I think the market assumes that Trump just uses as a negotiation tactics. But as we saw in the first presidency, some of the tariffs did come through for China, and that's just never get removed. So there is some degree of complacency there, and you see none of that is priced in for Europe, and none of that is priced in for the US. If that's going through, that might have a negative impact for the small and medium business in the US as well.
Good morning. You talked about a wider range of outcomes. If I'm seeing a wider range of outcomes, do I take less risk?
No, I think the answer is always diversification. I think in the global market practice, diversification is still an undervalued practice.
Yeah.
And at Royal London, we really not only focus on pick really highly idiosyncratic stocks, but the way how we put into the portfolio, not only diversify between the cyclical and defensive, but also across the corporate life cycle. And with that, you minimize the impact of macroeconomic volatility in your portfolio. So I think diversification is the answer. It's not risk off, it's risk on, but diversify.
The problem with diversification is that you've underperformed. Is because the cost of that is that I'm not in the concentrated areas of the market which have been outperforming tech stocks, etc., in the United States. Do those areas, that narrowness that we see in the markets, that concentration into tech, does that continue? Because if it does, then that undermines my argument around diversification. Diversification is a nice insurance policy to have because it allows me to deal with the sort of geopolitical risk. But if the concentration risk remains, then I'm underperforming.
Yeah, so what we mean with diversification is not taking smaller weights. What we mean is you try to eliminate the systematic risk, the beta in your portfolio, and let the stock picking to do the heavy work. And that has worked in the past years since the global equity was established at Royal London. It's when you have varying environment, you have stocks in accelerating, turnaround, and compounding part of the life cycle, and they will the idiosyncratic stock picking will come through and carry the performance forward.
Is that going to be more important this year than it has been over the last couple of years, do you think?
I think this is always important, but because we had over 10 years QE and the valuation simply goes up, so that gets de-emphasized in the market, I think this year is going to be very important.
And that strategy then, Bixuan, relies less on the Fed continuing to deliver rate cuts than you might expect, I suppose.
Exactly. So that's what we try to achieve. So whether the interest rates are going up or going down, you have the stocks in every corporate life cycle, and they're highly idiosyncratic. So you don't worry so much about the interest rate. We really try to minimize the interest rate impact in our portfolio and deliver the performance in a very balanced way.
What is your expectation, then, of this year and interest rates? Because it does seem that conversation is really in flux. We looked at the claims data yesterday. I mean, it's just one piece of data, but we looked at that yesterday, and some in the market were saying, well, this could be another reason why the Fed doesn't deliver on the rate cuts that the market is assuming. But there do seem to be quite a range of expectations as to how many cuts we get.
Yeah, so we try not to predict the macro. So last year when we started, I think the market looked for 5 times cut, and actually 2 times happened. So just tells us how unreliable prediction is. So what we try to do is really to have enough stocks that would benefit from a high rate environment, and have enough stock that would benefit from a
This is nice, Guy. This is a world where we don't need to predict the macro, and if the macro seems very unpredictable,
perfect.
Well, I live in this world.
Yeah, that's in theory what should happen.
Yeah.
Correlations are important, though. So how correlated do you think assets are going to be in the kind of scenario that we're talking about? Because in theory, if the boat tilts one way, you can compensate it with the other side, and kind of vice versa. Therefore, you end up on an even keel. That's the basic idea. But what we've learnt in past incidences where we've seen turbulence is that correlations are actually surprisingly high between asset classes. Do you think that will be the case again?
So that really depends on the inflation. So where the inflation will settle and how strong the U.S. economy is. So I think the downside risk that investors are acute aware is if the inflation is sticky for 2025 and Fed's hand is tied to cut more, then that's surely going to be negative for both equity and bond market.
If U.S. equities sell off hard, say there was a downdraft in US equities, would European equities sell off more or less than European equities in that scenario? I'm just kind of wondering how, does the rest of the world act as a diversifier against the US, or actually would you see an almost greater amplitude? The US catches a cold, the US sneezes, the rest of the world catches a cold.
So we think in the very long run, the US has much more attractive fundamentals, like attributes for shareholder wealth creation. But in the short run, there is a low bar to clear for European equities. So the valuation is very low. The valuation divergence is very high, and you have some white swans, right? So the end of Ukraine war could mean the energy prices finally stabilize, and that's hugely important for Germany and for the sentiment of Germany.
Yeah.
And the election might finally bring the policy and the reforms that Germany needs to boost the productivity. So it's a low bar to clear for Europe. But we think long-term, this divergence between European equity and US equity will persist. But for this year, given where we are with the valuation divergence, given where we are with the sentiment and external environment, we think European equity could definitely be the place for positive surprise.
Bixuan, nice to see you. Thank you very much indeed for coming to see us. Bixuan Xu, Global Equity Fund Manager at Royal London Asset Management. Thank you very much. Quick look at the Core 6, just to see what's happening. Centre of gravity here in Europe. Luxury stocks are under pressure. Some bid into ASML, but as you can see, LVMH is now down over 1%. There does seem to be a China read across this morning. What else are we watching? Let's find out. Joe's here.
So just wanted to check in on UBS today, because that rating upgrade that I flagged earlier is moving that stock. It was one of the best performing shares in Europe on the SXXP in early trading for UBS. Remember, the Swiss market reopening after the holiday, but that stock up 1.9%. Exane writing that changes to regulations by the Swiss government will allow the company to return more cash to shareholders, and therefore they go outperform on the stock. A 35 franc price target, trades at 28.30 at the moment. It's a decent upside, and that is driving that one higher today. Then an area of the market falling is shipping. This comes amid this decline in the Shanghai freight futures that we saw overnight, down as much as 9%. A big drop in those. A lot of attention, of course, on the strike situation in the US. Talks set to resume next week, according to latest reporting. But we're seeing the big names declining today. AP Moller Maersk, Hapag Lloyd and Frontline, giving us some excitement on a pretty slow day in those markets. Then in terms of the mining stocks, another bit of weakness, but a bit smaller. We are seeing the London names coming down, given the drop that we saw in iron ore overnight. Remember, iron ore was down around 2.5% at the low, so therefore Anglo, Rio, Glencore all falling the right way in terms of those moves. Then in terms of Airbus, we did get that reporting from our aerospace team on this delivery output from the company. Now slightly missing expectations in December, very, very slightly, according to the report. Around 120 aircraft sold last month. We'll get the full numbers next week, but that stock coming down, reacting to that in terms of Airbus at the moment. And then finally, a fallen giant of the London stock market in terms of the oil companies. Tullow Oil gets a bit of a boost today. Now, the company has a positive ruling on tax in Ghana, which is going to save it around 300 million quid, according to a statement. That stock rising 12%. Bear in mind, in its heyday, it traded around £12 a share. It now trades for 25 pence a share. But bear in mind, that is one of the biggest gainers in London today. Tullow Oil up 12% this morning.
Joe, thank you. Joe Easton from our equities team then with a review of some of those stocks that are on the move this morning. We will be talking about the car sector shortly. Coming up, Tesla reports its first annual sales drop in over a decade. Shares tumble. We'll take a closer look at the fallout next. This is Bloomberg. Welcome back to the opening trade, 8:17 here in London, and we see a bit of underperformance in the French market. Some of the luxury sector under pressure, it would seem, today. The likes of Kering and LVMH certainly putting pressure on the French market, but more broadly, stocks are flat. But it is interesting to ask whether this is part of the China weakness story once again coming through into Europe.
Really strong session for China bonds today. Yields continue to move lower. Chinese equities move sharply lower as well. We've got a big move in the currency market as well. We brought this to you a little bit earlier, talking to Paul Dobson, but it's worth coming back, I think, and reflecting on what is happening here. Dollar CNY, look at it. You can see the move. We're through 7.3. The Chinese have defended this level for quite some time. Is this an indication maybe that there are further falls still to come? One way of offsetting tariffs, you could argue, would be to let the currency go. You can pay attention to this. You should pay attention to this. Keep an eye on what is happening here, because this could be one of those kind of little tells as to what is about to happen next. And expectations in Beijing may be reflecting that. One car company that will be paying attention to this will be Tesla. Obviously, big manufacturing bases in both sides of that pair. The shares down almost 6% yesterday. This after Tesla reported its first annual vehicle sales drop in over a decade. The company sold 1.79 million vehicles last year, slightly less than it delivered in 2023, despite Elon Musk raising expectations that that number would be beaten. Our Asia transport reporter Danny Lee joins us now from Taipei. Danny, talk to us about the significance of this miss.
Yeah, I mean, investors really reacted negatively to this because of what, as you said, Tesla and Elon Musk have been talking about for slight growth. And it is a bit of a surprise given how much Tesla had been stoking incentives and promotions towards the latter half of last year. So it's that miss, particularly on the quarter. Although, look, the quarter was a tough one to try and get to because the kind of numbers it needed to achieve, frankly. And so this does generally invite the kind of questions from analysts about how narrow Tesla's lineup is and how small it is and how much a refresh of the lineup is probably it's not good enough. It needs to be something more fundamental in order to try and revitalize or to really push sales even higher. And clearly it has a pipeline going forward, but nothing really imminent yet. But hopefully 2025 that might change, particularly with an even cheaper Tesla coming around the corner.
And thinking of auto and battery diplomacy, Danny, China is looking to exert greater export curbs that make on those that make the key materials for EV batteries. What are they trying to do here?
Yeah, Beijing is trying to put tougher scrutiny, export controls on the kind of technologies that contribute to making the critical minerals, such as for lithium refining and for gallium. And so this is very much China signaling it wants to push back and to try and assert its influence on something it has been able to refine and develop over a multi-year period in order to become this kind of market leader. And these kind of pushback it's trying to make is the kind of thing, and it worries what Washington and Brussels, frankly, the kind of grip it has on the EV supply chain at large. And again, why we have seen over recent years how Washington and Brussels are trying to loosen China's grip on the EV supply chain more broadly.
Danny, thank you very much. Thanks for joining us. Bloomberg's Asia reporter, transport reporter, Danny Lee. Let's pivot from that to hedge funds. 2024 was an upbeat year for the hedge fund industry. In particular, multi-strategy funds of all sizes produced mostly double-digit gains. Large funds like Millennium, Citadel and DE Shaw had returns ranging from 15 to 36%. Bloomberg's Valerie Teitel is back with us and has been taking a deeper dive into some of the multi-strat news. Val, what drove then this strong year for these multi-strategy hedge funds?
Well, look, it was a volatile year, Anna. Not only did we have the volatility around the U.S. election, where a lot of these funds really did outperform in that month, we had an active central banks in that backdrop, which led the giant of the multi-strategy industry, Millennium, who has 72 billion assets under management, to gain some 15% this year, on par with Ken Griffin's Citadel, returning 15%. Also, we had DE Shaw, their macro multi-strategy fund, having its best year ever, returning some 36%. Many funds, again, looking to return profits to investors. They're not looking to retain these profits. A lot of these funds do say they're at capacity. They haven't even raised funds for some years. A lot of them pointing to a few elements out there of why they are at capacity.
OK, let's talk about them being capacity constrained. What is the limiting factor for these funds right now? Is it money? You just indicated it's not. They don't take new money, so they're pretty much there. Is it talent? What is the restraining factor that makes these that is stopping these funds actually getting bigger and better.
Yeah, well, the demand for these funds is there, that's for sure. What isn't there, though, is the talent needed to run this kind of money. Ken Griffin has even spoken vocally about the need to grow talent. They have just hired so many of these teams from across the street because the way that these multi-strategy works is they have hundreds of individual portfolio managers running their own pods. Essentially, they have hired all of them from the street. That talent war really heated up over the last few years. We've seen that in some of these massive deals that these portfolio managers have signed. And then the flip side to that is that you could get too big for this market. Yeah. We've seen that in the past where some of these funds just get too big. I guess it enables them not to be able to be nimble in these markets that they want to be able to trade. And also, they're also highly leveraged. So there is an inherent risk of being too big, causing, many out there to know your positions, and you can't necessarily trade in and out of them with ease. So, they're at capacity. The demand is still there. It's just going to be a question mark of where this money goes.
Yeah, it's really interesting, isn't it? Because, yes, the demand is there, and we talk to lots of investors who just talk about diversification, whether that's within their asset class or more broadly into lots of different assets. And that means alternative assets for many investors, and that brings hedge funds further and further into focus. So let me ask you about what investors are thinking about here, Val. Does it matter then that to investors that these hedge funds have underperformed the S&P 500? So we talked about the successes they've had, but in some areas we've seen that they haven't actually delivered as much as just the S&P.
Look, that is maybe something that the pessimistic person would say, but these investors out there don't necessarily view hedge funds as the S&P 500 being their main benchmark. What they're looking for is alpha. They're looking for a high Sharpe ratio. They're looking for stable returns, and a lot of these funds have returned that. Look at D.E. Shaw's main fund. They have never had a down year, and most of their years, a majority of their years, have been double-digit returns. So essentially, these multi-strategy funds allow investors to sleep at night. They're not worried about a massive drawdown, which you could see in the broader market. They want consistent returns that are diversified away from the broader market move.
How stress-tested has this model been, though, over the last few years? We're basically in a post-GFC world. Markets have just gone up. Liquidity's been there. Have we seen them stress tested yet?
One argument could be is that the higher for longer, no longer in this negative rate environment, could see one of these massive multi-managers blow up. There was a lot of worry about that, even from the Federal Reserve, when it comes to that very popular basis trade position in between cash and futures. But look, we haven't seen one of these massive multi-managers come under a stress, and they have weathered the storm of the, let's call it the pandemic, the most recent storm. They did weather that quite well. So maybe this is the next big thing for hedge funds in terms of this diversification model under the multi-strategy model. Ken Griffin being the shining light of that. He has said that this boom is over. And he has also said that the main reason why other multi-strategies have grown is because Citadel has returned all of their profits and that money needed to go somewhere else. They've returned $25 billion since 2016.
It's amazing, isn't it, that they try and give it back and investors say, no, we want to keep putting it into hedge funds. We don't want it back.
We've got to put it somewhere else, so why do we want it back from you? Valerie, thank you very much indeed. It's been another good year. 2025 is going to be interesting, though, isn't it? It's coming up. Europe is facing economic and political uncertainty, not to mention challenges from the next White House. The inauguration is at the end of this month. What is it going to mean for Europe's politicians? We're going to look at the continent's growth prospects in 2025 and talk about the relationship between politics and economics and markets. That's all coming up next. This is Bloomberg. Half past the hour, 30 minutes into today's equity trading session here in Europe. And actually, the CAC 40's really beginning to roll over now. We're down by 0.7%. In terms of the names that are driving that, it is the luxury space that is under pressure this morning. LVMH, Hermes, the two biggest points drops on the CAC 40. But Stellantis, Safra, Schneider and Airbus are all weaker as well in that market. What's interesting is that the FTSE 100 is holding up relatively well. Shell, BP, AstraZeneca and Unilever are the main points gainers on that market. Yes, the miners are lower. Yes, Rolls-Royce is a little bit lower. But it's being offset by basically the big oil companies coming through and some of the pharma names too. The other thing I just want to flag, and I'm going to keep flagging this, is this move we've seen through 7.3 on the Chinese, the US dollar versus the Chinese RMB, and you can see that's quite a decent move. Have the Chinese just let it move through that level? What does that signal? What comes next from the Chinese authorities? Is this a kind of, again, a prelude into the Trump trade and what we're seeing with tariffs?
Yeah, back in European stocks, weakness in autos and Stellantis in particular, also worth a mention. That on the back of the story you flagged, Guy, earlier, around a changing nature or designation of European car makers around credits in the US market, energy credits. And now let's talk about where we go in European politics. In Europe, the industrial sector is struggling. War rages in Ukraine and the political instability plagues France and Germany. We talk about it often. According to Bloomberg Economics, there was already little chance of a growth revival this year, but now the threat of tariffs and further delay, or could further delay, the region's recovery. For more, let's bring in Antonio Barroso from Bloomberg Economics. Antonio, let's start with thinking about France. Clearly, we're still in a period of uncertainty around what any French budget for this year is going to look like.
Oh, absolutely. You have a country that starts this year as it ended the last one, with no budget for 2025 and a weak government, a government that has no parliamentary majority, and that it's going to have to find some sort of deal to get a budget approved. That's going to be tough. The rumor is that maybe it might rely on last year's draft budget that failed as a template, and then we'll try to get some amendments on so it can get the support from other parties. But it's going to be really tough for the new government of Prime Minister François Bayrou. And if it doesn't manage to pass a budget, we might well see potential no-confidence motions that might lead to a political crisis even in the first quarter of this year.
Let's talk about Germany as well. We have elections coming up in February, and we're all looking forward to those to get maybe a sense of stability out of instability. Are we going to get that stability from the next German government? Are we clear that this German government is going to be able to deliver the turnaround that everybody's hoping for?
Well, it's going to be tough because parliament is also highly fragmented in Germany. And as we all know, the current coalition collapsed basically over disagreements on how to pass a budget. And I think parties remain far apart on economic and also social issues. I think the main challenge after the election actually will be to form a government. If you look at the average duration of government formation in Germany for the last 3 to 4 elections, it takes a lot of time to form a government. And it's going to be probably a coalition government because the CDU, the center-right party that is leading the polls, it's unlikely that it will have enough seats to form a government on its own. So it might need the support of other parties, such as the Social Democratic Party, that is currently ruling the coalition in Germany, or the Greens. That's going to be tough. If you look at the programs of the different political parties, there are some economic issues on which they agree, but they're very far apart on certain economic issues and cultural issues. So even forming a government might be difficult. The main question is whether, obviously, the threat of tariffs coming from the Trump administration in the US or the upcoming economic slowdown might cajole political parties into actually forming a government faster than in the past.
Yeah, Antonio, and so add into the mix then the threat of tariffs. What impact are we expecting to see from Trump's tariffs on the European economy? And I wonder if we do look at the Eurozone-wide impact or whether the US strategy might be to cause some disruption and divergence between parts of Europe.
You're absolutely right. I mean, the impact will depend on the kind of tariffs that are imposed, and then it really depends on what happens, because the strategy of the EU, I think it will be very clear. First, try to negotiate a deal. If that doesn't work, then they will retaliate. Now, the key question to monitor, I think, is whether the EU will be able to master the unity to develop a unified response, so to speak. So let's say that Trump imposes a blanket tariffs, for example, on the EU. Then I think it will be relatively easy for the EU to respond because most countries will be affected and you will have the European Commission leading the response. The problem is, what if Trump starts offering specific concessions to specific countries and those countries decide to go on their own? Let's just say that, for example, Italy picks Italian olives over the European interests, so to speak, and then they don't back a response to the US in the Council, which is where member states meet in the EU, right? So I think that's the main question. How united will the EU remain in the face of US tariffs?
Antonio, great stuff. Thank you very much indeed. Antonio Barroso joining us from Bloomberg Economics. Christine Lagarde seems to think the easy way to deal with this is simply to just buy more US energy and deal with the trade deficit that way. Is that going to be the way that Europe needs to go? Maybe. Let's talk about what the European energy story looks like in 2025. We have seen gas prices edge a little bit higher over the last few days. This on the back of the ending of the transit agreements between Russia and Ukraine. LNG plants in Norway have also been seeing some issues as well. There's a compressor failure. That feels like it's more sort of idiosyncratic and therefore is more manageable from the market point of view. But what is the bigger picture here? Florence Schmit, energy strategist at Rabobank, joining us around the table this morning to discuss. Got political instability. We've just been talking about that in Europe. Lots of kind of governments in turmoil right now, need to make big decisions on what the energy story is going to be looking like. You've got potentially Trump coming in with tariffs. Lagarde thinks we just buy more US gas. How complicated is the picture going into 2025 for European gas? How much clarity do you have as to what price development is going to look like?
I think if we're talking about European gas, we have to consider the future of Russian gas within the European energy mix first and foremost, right? We lost around 5% of the Russian pipeline flows on Wednesday. We still get some Russian gas through the Turk Stream pipeline into the European system. But there's a very big chance that actually we will see a rise of Russian LNG imports in 2025 into the European market. That is because right now, our demand for LNG will be rising in 2025 because we lost some pipeline supplies, because this winter has already been relatively cold. We had quite a lot of storage depletion already. So that means throughout the summer we'll see higher LNG demand. Some of it will come from the US, but also some of it might come from Russia if the regulatory framework doesn't change, if there's no sanctions imposed. We've seen it already in 2024. We had record high imports of Russian LNG, although, your pipeline deliveries have been declining. And it looks like 2025 could be a similar picture.
Can the US deliver more gas?
The US can deliver more gas in 2025. As we speak, there's more LNG terminals in the US ramping up. By the end of Q1, we might have 2 additional terminals. That should help the market a little bit. But at the end of the day, it's a question of price. Whoever is willing to pay a higher price can receive these additional volumes of LNG from the US market. And this is, again, where the European market goes into competition with Asia for the additional LNG supply.
Good morning to you, Florence. So has LNG, give us a sense of the scale at which LNG has transformed the nature of the gas market, made it more international in a way that it was quite domestic, or regional at least, many years ago.
Yeah, in many ways, it's trading more like the crude markets have been for years, right? The European market is now very much exposed to any supply disruption coming from major LNG exporters like the US, like Qatar, and at the same time is exposed to, how does demand develop in Asian markets, heavily competing, for the few LNG volumes that we have in the market as we speak. So, of course, now it doesn't matter anymore if the weather in Europe might not be as cold. If it gets really cold in Asia, we will see the impact here as well, and we'll see a price impact as well.
And Florence, what do we expect to see if we do get some sort of peace agreement, whatever that might look like, in Ukraine this year? New President Trump in the United States likes to talk about this being possibly delivered. If we do see something that looks much more peaceful, do we have any sense of what Europe's policy towards Russian energy will be? I mean, is it too... Has that dice has already been rolled? We've already made the decision, there's no going back, and Russia is now going to be cut off from 2027?
Well, I wouldn't say there's no going back. Of course, there's a target of phasing out all Russian hydrocarbons 2027. The key challenge will be gas and LNG, of course. I do think if the war were come to an end, and depending on what that looks, we could see an increase in flows, especially Russian pipeline flows. We will never go back to the levels that we had pre-energy crisis. Infrastructurally speaking, that's not really possible anymore, but I do think that there is a potential for some of those flows to come back. Again, it also depends on European politicians, where they want to go and how they see this develop beyond 2027. But I wouldn't say it's off the table.
Europe's got this kind of duration mismatch issue as well, in as much as it wants to do an energy transition. It's trying to do that. That's expensive, but it's got other things it needs to spend money on as well, increasingly defence. So you wonder how quickly that energy transition is going to proceed. It's getting expensive gas now. Gas is going to remain expensive. Still got coal. Less nuclear. Still got coal. Are we going to be burning more coal in Europe, do you think?
Well, the problem with coal is that it is still much, much cheaper than gas, right? And we've been seeing it especially this winter where because of the high gas prices, some of the coal plants came back into the mix because it's simply cheaper. We had periods of very little renewable power generation, especially from wind and solar, of course, because we're in the winter. And during these periods, you can see how important it is to have some backup supply. And sometimes coal comes back into the mix because, of the lower price point versus gas.
And can I ask you about the thinking about US LNG or US energy products and where they go? We've talked about the LNG market a little bit, Florence, but we've heard President-elect Trump talk about how he wants Europe to buy more energy from the United States. Tell us a bit about those contracts, those long-term contracts, because often we see governments mentioned here and governments taking a leading role here, but we're talking about these are businesses involved in buying and selling energy rather than government bodies themselves. So talk to us about how Europe can and might respond to what President-elect Trump is asking for.
Well, it's a very interesting one because, as you rightfully said, at the end of the day, it's businesses who decide, or the market who decides, where the LNG is going to. I think the concern here is that actually Trump might force some European nations to sign more longer-term LNG contracts with the US, which could also be a problem for the energy transition, and which is also a reason why in the past, at least over the last 2 years, we haven't seen, a huge number of these contracts being signed, especially not the very long-term ones. So it really depends on how these negotiations between, the Trump administration and the EU will go. But I think there's a bit concern that, might pressure some of the EU member states to sign more longer-term contracts.
So do you think how reliable is the US as a provider of energy? I'm really curious. In theory, it's really logical. The US produces a lot of gas. Gas prices in the US are really low. That's great for the US, great for the AI story. We start selling it around the world. But is energy a weapon? Should Europe be nervous about buying gas from the United States? How reliable are these long-term contracts going to be? Because we're trying to figure out how we stabilise our energy sources. You've got Qatar providing a lot of gas, has to come through the Straits of Hormuz. You've got US providing a lot. Where's the most reliable energy source that Europe has right now?
Well, I mean, in theory, the US is a very reliable energy supplier to the European market, and they've shown that as well over the last few years. Now, Norway has stepped up massively since 2022, but there's a limit to how much, especially gas, they can export to the European market.
Is it politically popular in Norway that it keeps selling a lot of energy elsewhere?
I mean, as long as it helps the European market and it helps stability, it is. Because that's at the end of the day what everyone is concerned about. Energy security, of course, and where are all these, hydrocarbons coming from? Of course, Europe is short. Most energy products, we need to import a lot from the US, from Qatar, which is also why we're still getting a lot from Russia as well in terms of LNG.
Is Europe ever going to be energy independent? Is this going to be a problem for our economy?
I mean, energy independent is a big word. I think it really depends on the pace of the energy transition and what that will look like, because, of course, the more renewables we have in the system, the more independent we are. But then at the end of the day, gas will play a role within the energy transition and beyond as well. We're seeing the ramp up of new gas-fired capacity, and that gas has to come from somewhere in the future as well. And
German industry relies on that as well. And there's all kinds of other factors we need to throw into the mix as well. Florence, great to see you. Really interesting conversation. Florence Schmit, energy strategist, joining us from Rabobank. Coming up, why London is the best place to be if you want to work from home. Maybe you don't want to work in London. Actually, you want to work from home. We're going to bring you the details of a Bloomberg Intelligence remote working survey. That conversation coming up next. This is Bloomberg.
Welcome back to the opening trade, Friday the 3rd of January. European equity markets under pressure this morning. In particular, the CAC 40 actually down by 0.9%. A bit of catch-up from yesterday's session in the United States, but actually some nervousness around China and fast-moving events there seems to be something that's weighing on some of the luxury names. Sticking with the luxury theme, luxury Swiss watch brand Rolex has raised prices on some of its most popular models after gold prices surged in 2024. Bloomberg's Andy Hoffman is in Geneva and has everything we need to know about the luxury watch sector sector. Andy, very nice to see you. Happy New Year. So is it unusual then for Rolex to raise prices like this at the start of this year? And is this just because they're having to pay more for the gold that goes into them? What's the driver?
Well, it's a good question. And indeed, it is not unusual for Rolex to raise prices once a year on January 1st. But what's different this year is the amount by which they've raised prices. So for some of the most popular models, the Day-Date, the GMT Master 2, models like that are in gold have been raised by more than 8%. In fact, the precious metal Daytona Cosmograph models, the famous chronograph, have been raised by as much as 13%. Now, what is this all about? Is it just about gold prices? Well, in part, certainly. We saw gold rise by about 27% in 2024. And traditionally, Rolex raises prices once a year on January 1st. This year, though, those price hikes are higher than they were in 2024. 2024, 2 to 4% about. So this year, they took a lot more.
Are others doing something similar? What's Omega doing? What's Cartier doing? Is this a Rolex story? Is this an industry story?
Well, 2024 was not a great year for the Swiss watch industry after a massive boom, an unprecedented boom in demand, during the COVID and post-COVID era. It was a tough year. Swiss watch exports were going to find out, we're going to confirm, we're down in 2024 after 3 years of records. Now, are other watch brands raising prices? Not like this, because Rolex operates in a league of its own. Rolex determines the market. Demand for its watches is almost inelastic. Waiting lists remain for all of its most popular models. Although, to be fair, there's no doubt that those waiting lists have come down from those unprecedented boom era. But the other brands simply don't have the pricing power that Rolex has. Rolex can raise prices and customers will continue to pay it. For other brands, which certainly did raise prices during the boom, they're now finding some pushback from customers. Brands like Omega, even Patek Philippe and Audemars Piguet. Customers are thinking twice about what they're paying for luxury watches, but Rolex customers continue to be willing to pay those increased prices.
Yeah, and Andy, you're a watcher of this sector at large, and I wonder when you look for whether you look for macro indicators in this sector, or if it's just not possible, because you've just highlighted how some of the demand story here is pretty inelastic and is driven by all kinds of other factors. Is there anything macro that any of this tells us?
Absolutely. I mean, look, Rolex is the behemoth in this industry. They make over 1 million watches a year, according to analyst estimates at places like Morgan Stanley and RBC. Their revenue is about over 10 billion Swiss francs. And so the pricing that they utilize or decide on for various markets tells us a lot. It tells us about the strength of the Swiss economy, the Swiss franc, as compared to other currencies. It tells us about demand for luxury goods in general. And it tells us also about raw material costs, inputs like gold, like other precious metals that are used in these products. And so, this massive market that's estimated to be about $50 billion a year, the global luxury watch market, the prices and demand and imports in various markets tells us a lot about macro demand. I mean, obviously, at the center of the troubles that the industry has is China, and that's we know that macroeconomically China is struggling.
Kind of an asset class all of its own. Andy, great to catch up. Thank you very much indeed. Always appreciate it. Andy Hoffman joining us out of Geneva. Let's turn our attention to some of the other European cities and capitals. A tight labour market and the race to attract and retain talent may have prompted London-based businesses to offer more flexibility to their staff. The results from the Work from Home survey by Bloomberg Intelligence shows that 89% of London-based employers are amiable to remote working, more than peers in other European cities. Why is this? Sue Munden, Senior Analyst for Real Estate at Bloomberg Intelligence, joins us now. Why? Why are we doing this in London? Why we're not doing it elsewhere? London's a lovely city. They can bring up the skyline shot this morning. London's a great place to go work. It's a place to go to work.
It is a lovely day, isn't it? Well, London actually isn't that different from Europe. Europe and New York are about the point of 70% of staff getting some flexibility. That's 1 to 4 days a week. Then on either end, there are some only remote and some only in the office.
Yep.
In the office is very small, 11% in London, 7%,
yep,
and 22% in Paris, so a bit higher. Hong Kong and Tokyo are a bit different. They've got sort of 35 to 40% of staff back in the office.
But it does seem as if there are some parts of Europe where you don't have the option to work from home quite so much. Is that one of the conclusions then, Sue, from the report?
Well, Paris is moving a bit more to coming back to the office, yes, and we think that and also in Asia is more to do with the labour market and whether, the employers have got the upper hand or the employees have.
Are we going to finally see this plus higher for longer rates having the impact that we've been waiting for in the London property market, other property markets in 2025? Is this the year when this all gets priced in effectively?
I think it's fairly stable. If anything, things are moving a bit more to hybrid from only being remote.
Right.
But the other thing that's interesting is if you look at the landlords and what they're doing,
yep,
they're really gearing up for there to be continued hybrid work. We are seeing more businesses upsizing than downsizing, and there is a lot going to co-working. So what they're trying to do is to fit the hybrid model into what the tenants need. The preferences are to have, well-located offices, because everybody hates the commute. That's one thing that came through very, very strongly in our... but to enable networking. So co-working is really coming up through the ranks, and so landlords are having to change their lease structures in order to be able to accommodate short lets, which is what they want, and also fitting out offices. But they can get 50% more rent for that in London.
11% people come into the office on a 5-day... We're the minority.
We
do this every day.
We're very vocal.
Yes.
So
we are the vocal
much.
Minority. Yeah, great stuff. Thank you, Sue. Let's talk about the weekend.
Yes. Did you find anything that is happening this weekend?
This is a bit of a non-weekend.
Yes.
I think dry January kicks in.
You thought it was Monday. So, I don't know what that tells us about our engagement with the weekend.
Yeah, precisely. I thought it doesn't feel like it's going to be much of a weekend. There's a half marathon in London, Battersea Park, if you want to go and pay attention. I think there's some great Gallagher rugby on this weekend.
There's always some sport, but the weather will be atrocious. Well, here in London, I think, parts of the weekend.
So it's really great today. The London shot we just showed you, absolutely lovely today, and then it starts raining over the weekend. Liverpool versus Manchester United. I think that's probably the highlight of the sporting story. I think next weekend looks better, so things start to get a little bit more exciting.
Yes.
But it's dry. Loads of people doing dry January. This has got to be one of the more depressing weekends of the year.
That's fairly tragic, isn't it? And if you are looking for things to do on a wet weekend, then you could do worse than stay in and read Bloomberg weekend content. We bring you a collection of interviews, ideas and stories that explore the fascinating places where finance, life and culture meet. I'll be reading it if the rain continues. That is it for the opening trade. The Pulse is up next. This is Bloomberg.